The first three are funded, but a company cannot survive. You mentioned the AI integration saving them 17. Or is it a precarious, speculative microcap?
Percent share of the production revenue at absolute wells online in the second quarter of 2020 requirements that usually lock micro.
And this brings us right back to the
Who is buying every single stock? Who is really behind the dark pool activity? Watch until the end and you will find out more.
On March 3rd, 2026, EON Resources, ticker EONR, experienced a massive price surge to $0.64, 64 cents a share. Pause. That move was driven by trading volume that was an astonishing 3,353% higher than its 65-day moving average. Thoughtful pause. The stock aggressively broke its 10-day, 50-day, and 200-day moving averages in a sustained 3-day bullish advance before finally settling at 56 cents in after-hours trading on March 4th.
Those numbers are, they are truly staggering when you hear them laid out like that, especially for a micro-cap upstream energy company operating out of the Permian Basin.
Exactly. And for context, this is the entity formerly known as the SPAC EONR Acquisition Corp. They are currently attempting a massive operational and financial turnaround across their 20,000 leasehold acres. Pause. The central question we are debating today is this. Is EONR's current valuation the ground floor of a fundamentally de-risked, highly lucrative transition to horizontal drilling,
Or is it a precarious, speculative microcap reliant entirely on unproven execution and highly complex financial engineering?
Right, that is the exact tension. And my perspective is that the recent strategic overhaul we've seen, specifically the Virtus farm out, the aggressive debt retirement, and the massive insider accumulation, well, it serves as a masterclass in risk mitigation. I believe it perfectly primes this company for exponential production growth.
And I view it from the other side of the coin. Thoughtful pause. The structural complexities surrounding EONR, most notably its reliance on non-binding funding, high off-exchange short volumes, and the recent accounting restatements, these represent severe execution risks. Risks that, frankly, completely overshadow the theoretical upside you might see on a spreadsheet.
To understand why I see this as a masterclass in risk mitigation, we really have to break down the brilliance of their structural turnaround. They have systematically shifted risk off their own balance sheet. The ultimate catalyst here is the joint development and farm-out agreement with Virtus Energy Partners.
Ah, the famous Virtus carry.
Yes, the carry. It is absolutely vital. EONR sold a 65% working interest in their San Andreas formation rights for $5 million in cash. But crucially, they retained a 35% non-operated working interest. The defining feature here is that carry mechanism. For our listeners who might not be deep into oil field financing, a carry essentially means Virtus is obligated to foot the entire bill for the first 3 horizontal wells, which are slated for completion in the second quarter of 2026.
It's essentially like a contractor agreeing to build a highly lucrative addition on your house for free, with the caveat that they get to keep a percentage of the rental income it generates.
That's a perfect analogy. EONR gets to realize their 35% share of the production revenue at absolute zero capital cost to themselves. Pause. And beyond that, the balance sheet cleansing has been nothing short of surgical. By settling their debt with Pogo Royalty, they eliminated $40 million in obligations. Furthermore, they wiped out $27 million in highly toxic, dilutive preferred shares.
And preferred shares in a microcap can be a complete death spiral if they aren't handled carefully.
Exactly. They're notorious for destroying common equity. But EONR managed to exchange those for just 1.5 million common shares. It's a massive win. Finally, you simply cannot ignore the insider alignment here. Management currently owns over 5 million shares. That kind of profound skin in the game strongly aligns the executive team with the common shareholder. They aren't just managing the company, they are betting their own wealth on this turnaround.
I hear all of that, and I acknowledge the theoretical beauty of the Virtus farm-out on a financial model, but I come at it from a very different way. Thoughtful pause. There is a vast distinction between a clean spreadsheet in a boardroom and the harsh, unforgiving realities of the oil field.
You're talking about the legacy assets.
I'm talking about the execution risks across the board.
The liquidity constraints here are palpable. Let's just look at their recent history with those legacy vertical wells. EONR has significantly struggled just to keep the lights on with their existing infrastructure. Due to mechanical issues with their water injection equipment, production dropped to just 615 net barrels per day. They completely missed their internal target of 766 barrels per day.
Well, water injection is notoriously tricky in older fields, though.
It is, absolutely. But missing a baseline target by that margin raises immediate questions about operational competence for a team that is about to embark on a massive horizontal drilling campaign. Pause. Furthermore, you mentioned the cleansed balance sheet, but we have to look at the $52.8 million end-stream capital volumetric funding arrangement. That funding is absolutely essential for their operations outside of the Virtus carry. And right now, it is currently just a non-binding letter of intent. It is not locked in.
Letters of intent are standard operating procedure before final closing.
Standard, yes, but not guaranteed. Add to that the February 24, 2026, Item 4.02 accounting restatement regarding their Class B equity units. I know it's a non-cash adjustment, but whenever a company has to restate historical financials, it blatantly signals internal control weaknesses. And finally, if we look at the smart money skepticism, the off-exchange short volume ratios frequently exceeded 50% in late February. It actually hit 59.76% on February 23rd. Coupled with TD Bank requiring a punitive 25% margin for U.S. investors, the institutional ecosystem clearly perceives severe volatility and risk here, not a guaranteed smooth turnaround.
I see why you think that, but let me give you a different perspective on their operational execution and geological strategy. Because I believe the specific geology of the Grayburg-Jackson field fundamentally supports this operational pivot, and it mitigates a lot of the risk you just outlined.
How so? The rocks don't change just because management restructured the debt?
No, but the methodology of extraction does. The San Andres Formation is remarkably shallow. We are talking about 1,500 to 6,000 feet in true vertical depth. Because of the lower formation pore pressure and the specific fracturing gradients there, EONR can execute incredibly low-cost horizontal drilling. Pause. They estimate it at just $3.7 million per well.
Which is undeniably cheap for the Permian Basin.
Extremely cheap. And a big reason for that is they don't need expensive rotary steerable systems to drill these wells. They can use simple, cost-effective mud motors.
For the sake of clarity, rotary steerable systems are essentially the GPS-guided sports cars of the drilling world. You only pay for them if you're navigating incredibly complex, deep-earth hairpin turns. Mud motors are more like driving a reliable, old manual truck straight down a dirt road.
Precisely. Because the target formation is shallow and relatively straightforward, the old, reliable truck works perfectly. They have already identified 50 locations targeting 20 million unlocked barrels, and they are projecting 300 to 400 barrels of oil per day per well. Thoughtful pause. And regarding their management of those older legacy assets you mentioned, they aren't just letting them decay while they wait for the new wells. They have implemented an artificial intelligence application for their well pumpers.
AI in the oil patch is a buzzword we hear a lot lately.
It is, but here it's actually yielding tangible results. It optimizes the pump cycles and predicts mechanical failures before they happen. That technological integration has already reduced their lease operating expenses from a 2024 run rate of $700,000 a month down to $683,000 a month in the first quarter of 2025. The operational pivot is highly calculated, and it is directly supported by the geological realities of the basin.
That's a compelling argument. But have you considered the steep decline risks inherent in transitioning from vertical to horizontal drilling in highly mature fields?
Decline curves are a reality of any horizontal well, yes.
But they are especially brutal in mature fields. Yes, the drilling is cheaper because it's shallow and they can use mud motors. But we cannot forget that this is a former SPAC that is only just now trying to prove it can manage the assets it already owns. You mentioned the AI integration saving them $17,000 a month. That's great. But just recently, they had to rely on basic acid treatments just to stabilize the physical infrastructure and get production back over 1,000 barrels per day.
Acid treatments are standard maintenance to clear out scaling and corrosion in older pipes.
Standard, yes, but it highlights the fragility of a 50-year-old infrastructure. You are putting a Band-Aid on aging metal. And now, on top of managing that aging infrastructure, they are layering on the integration of the newly acquired South Justice Field. That acquisition consists of 208 combined producing and injection wells targeting 5 different geological formations. That is a massive, complex operational burden.
But it significantly expands their footprint.
On paper, yes, but the long-term projection that this 92-well horizontal program will eventually hit 20,000 barrels of oil per day relies on an assumption of flawless, uninterrupted execution. For a company that recently struggled to maintain just 766 barrels a day due to water injection failures, scaling up to manage a complex horizontal program while simultaneously integrating hundreds of new wells across multiple producing intervals requires an operational precision they simply have not demonstrated yet.
That's an interesting point, though I would frame it differently. The very reason they can afford to take on that operational scaling, and yes, I agree it is a significant scaling effort, is precisely because their capital structure is now a fortress. It provides them the financial flexibility to weather operational hiccups. Let's look closer at that February accounting restatement you brought up earlier as a red flag.
The Item 4.0 restatement on the Class B equity units.
Right. The market usually panics at the word restatement, but let's look at what the math actually did. That restatement actually served to reduce the 2023 net losses attributed to shareholders from $9.0 million down to $6.7 million. It improved the metric.
But it still shows the accounting department wasn't catching complex equity classification errors?
Perhaps, but management explicitly confirmed it had zero impact on the $60.9 million in total shareholder equity. It was a non-cash paper adjustment that does not affect their physical cash runway whatsoever.
Pause. Furthermore, their forward-looking liquidity is rigorously protected. They have established aggressive hedges on their production.
Hedging is standard, though. It is, but look at the levels. They've locked in 60% of their remaining 2026 production and 50% of their first quarter 2027 production at average floor prices exceeding $60 per barrel. By utilizing futures-based swaps, they have completely insulated themselves from downside commodity risk during a highly volatile global election year. If oil crashes, EONR still gets paid. This gives them highly predictable baseline cash flows to support their future banking needs and development plans.
I'm sorry, but I just don't buy that the capital structure's a fortress. We have to examine the long-term costs of this newfound liquidity. How did they actually fund that massive POGO debt restructuring? They didn't just find loose change in the couch. They did it by selling perpetual overriding royalty interests, ORRIs.
Right, a 15% perpetual ORI on the existing Grayburg-Jackson wells and a 5% ORI on the future San Andreas wells.
Exactly. And for our listeners, an ORI means you are carving out a percentage of your top-line revenue forever. It's not tied to profit. It comes right off the top before a single operational bill is paid. So yes, their balance sheet looks much cleaner today, but they are quite literally mortgaging their future margins just to survive the present.
It was a necessary trade-off to eliminate $40 million in debt.
I agree it was necessary, but it has severe consequences. When you start skimming 5 to 15% off the top in perpetuity, the economics of those future horizontal wells get incredibly tight. And this brings us right back to the Endstream Capital deal. If that $52.8 million non-binding volumetric funding arrangement does not successfully close, their cash runway for operations outside the Virtus carry becomes incredibly precarious.
They still have the carry for the first 3 wells.
Yes, the first 3 are funded, but a company cannot survive long-term on a 3-well carry alone. If they cannot secure that binding capital from Endstream to retire the remaining senior debt and fund their portion of the broader field development, all the $60 hedging in the world won't save them from a fundamental liquidity crisis.
I'm not convinced by that line of reasoning because it ignores the undeniable wave of institutional accumulation we saw in the first quarter of 2026. The broader financial ecosystem clearly believes that funding will materialize and the turnaround will succeed.
Institutional filings can be deceiving.
We are talking about major, sophisticated players stepping into this microcap. State Street Corporation reported a brand new position of 134,000 shares in mid-February. UBS Group increased its holdings by over 54%.
Even Goldman Sachs initiated a new position.
Those are big names, absolutely.
You simply do not see that kind of high-profile institutional entry into a $25 million microcap unless their internal algorithmic modeling shows massive asymmetrical upside. Furthermore, the macroeconomic tailwinds are perfectly aligning with EONR's 2026 drilling catalysts. The market is currently heavily engaged in the Trump taco trade dynamics.
The geopolitical premium on crude.
Exactly. We are seeing severe geopolitical tensions in the Middle East constantly pushing oil prices above $80 a barrel. For a domestic revenue-generating producer with a freshly cleaned balance sheet like ENR, this macro environment is a dream. It drastically accelerates the timeline for their 92-well project to become entirely self-sustaining.
I think we need to aggressively recontextualize that institutional data you just laid out. Yes, names like UBS and State Street are on the ledger, but look closely at the other major participants who increased their holdings. XTX, Topco, and Virtue Financial.
They are still massive market participants.
They are, but they are not fundamental long-term believers in the San Andreas Formation. They are quantitative algorithmic liquidity providers. They are quants. When you see firms like that taking large positions, it perfectly explains the massive dark pool activity we are witnessing on the tape.
The off-exchange volume.
Right.
On February 23rd alone, there were 334,377 off-exchange short shares traded. The high short volume ratio in off-exchange venues, hitting nearly 60% on some days, suggests that these sophisticated participants are using dark pools to aggressively hedge their long positions. Or, more likely, they are executing complex market-making strategies to harvest the volatility of the stock. They aren't holding the stock because they believe in the oil. They are scalping the math.
But a short volume ratio doesn't strictly mean active short selling. It includes market maker hedging. True, but look at the cost to borrow. The borrow fee rates on interactive brokers are hovering around 4.87 to 4.97% with up to 1 million shares available to short. That tells me the smart money is playing the massive mathematical volatility of a tightly held microcap. They are trading the wild swings of a debt restructuring rather than blindly betting on the physical, boots-on-the-ground extraction of oil over the next 5 years.
Let's pull all of these threads together. Thoughtful pause. To summarize my position on the material we've covered today, EON Resources represents a rare asymmetrical opportunity in the microcap energy space, primarily because the heaviest lifting is already complete. They have successfully retired $40 million in debt, eliminated the toxic preferred equity, and secured fully carried capital from Virtus for the critical initial phase of their horizontal program.
The financial restructuring is certainly complete on paper.
And it paves the way for the operational shift. By utilizing the shallow, low-pressure geology of the San Andreas Formation, they can drill highly economical wells with basic mud motors. They completely sidestep the massive, prohibitive capital requirements that usually lock microcaps out of the Permian Basin. This fundamental operational pivot, combined with extreme insider conviction of over 5 million shares, heavily supports the massive market breakout we observed on March 3rd. The structural barriers to growth have been systematically removed.
And to summarize my stance on the material, while EON Resources' structural and financial maneuvers are admittedly impressive on a spreadsheet, the company remains a highly complex, precarious microcap. The true test of their valuation is not financial engineering. The true test is operational reality.
Execution.
Exactly. Execution. They must prove they can physically extract oil horizontally at scale without suffering the steep decline rates common in mature fields. And they have to do this all while managing the integration of hundreds of newly acquired, aging legacy wells from the South Justice acquisition.
It is a significant operational load.
It's a massive load. Furthermore, they are attempting this while navigating incredibly tight long-term liquidity constraints. They are relying on non-binding letters of intent from Enstream, and they are operating under the shadow of internal control scrutiny highlighted by their recent accounting restatement. The intense dark pool activity, the algorithmic trading, and the punitive 25% margin requirements from institutions like TD Bank clearly indicate that the broader market recognizes these severe execution risks.
Analyzing a microcap turnaround of this magnitude requires us to constantly shift our perspective. We have to look through a deeply geological lens one minute and a highly quantitative market lens the next. Both frameworks reveal crucial truths about the realities of operating in the modern Permian Basin.
Absolutely. The tension between theoretical financial modeling and the physical, muddy limitations of the oil field is exactly where the true risk and reward of this sector is decided. The complexities we've discussed today demand rigorous, ongoing scrutiny.
As EON Resources brings their first 3 horizontal wells online in the second quarter of 2026, the material outcomes will inevitably provide definitive answers to the questions we've explored today. Until then, the true valuation of this turnaround remains a matter of perspective, leaving much more for all of us to explore.
If you like this content and want to watch more videos like this, then don't forget to subscribe. Thanks for watching. See ya!